Alright, before we get into the secret weapons that will completely transform you from a nervous beginner into a confident investor, we need to do the official serious voice thing for a second. I am not a financial advisor. This video is for educational and informational purposes only, and it is not financial advice. Investing involves risk, including the potential loss of principal. You should always do your own research and consider consulting with a qualified financial professional to determine what's right for your individual situation. Okay, my job here isn't to give you a hot stock tip that will make you a millionaire tomorrow. My job is to give you the tools, the framework, and the confidence to build wealth for yourself brick by brick over the long term. That's the real goal. Now let's talk about that feeling. You know the one. You've decided you're going to do it. You're going to start investing. You open your laptop, you type how to buy stocks into Google, and you are immediately hit by a digital tsunami. A million different websites, 1,000 different gurus in rented Lamborghinis, all screaming at you. Use my platform. Buy this crypto. You need to understand stochastic oscillators and Fibonacci retracements. It's an information blizzard. And what happens? For most people, you get buried. You get analysis paralysis. You feel overwhelmed, you feel stupid, and you just close the laptop. You tell yourself you'll figure it out later. But later never comes. What if I told you that feeling isn't your fault? You're not bad with money. You're not lazy. You've just been handed a map of the world and told to find a specific coffee shop in a city you've never been to. And the map is written in a language you don't understand. The problem isn't you. It's that nobody has given you the right tools. Nobody has given you the GPS. That ends today. Right here, right now. In this video, I am going to give you the ultimate beginner investor's toolkit for 2024. We are going to cut through 100% of the noise and focus on the handful of tools that actually matter. The ones that are easy to use, powerful, and will set you up for decades of success. We're going to cover the 3 most critical pillars of your investing journey. First, your brokerage, which is the secure vault where you'll actually buy and hold your investments. Second, your research hub, the command center where you'll learn about companies and make smart decisions. And third, your news source, the intelligence briefing that keeps you informed without driving you crazy. By the end of this, you will have a crystal clear step-by-step plan. No more confusion. No more paralysis. Just confidence. Let's start with the single most important decision you will make as a new investor. Choosing your brokerage. Think of a brokerage as the Amazon for your investments. It's the online platform where you go to buy and sell stocks, ETFs, mutual funds, and other assets. It's the home base for your entire financial future. And just like choosing a home, you want one that is safe, reliable, and easy to live in. For a beginner in the United States, there are 3 things that matter more than anything else. 0 commissions, a user-friendly interface, and a company that isn't trying to trick you. For decades, you had to pay a fee called a commission every single time you bought or sold a stock. Imagine paying a $7 fee to buy a $50 stock. It was a huge barrier. But today the game has changed. All the major players now offer 0 commission trading on US stocks and ETFs. If a brokerage is trying to charge you a commission to buy a share of Apple, close the tab. It's a dinosaur. Second, the platform needs to be intuitive. It shouldn't feel like you're trying to fly a 747. It should be clean, simple, and easy to navigate. You want to be able to find what you're looking for, place a trade, and check your performance without needing a PhD in computer science. And third, and this is the most subtle but most important point, you want a brokerage that treats you like a long-term investor, not a gambler at a casino. Some of the newer, glitzier apps are designed with flashing lights, confetti, and push notifications to encourage you to trade constantly. This is called gamification. And it's not designed to make you wealthy. It's designed to make them wealthy through other means. Constant trading is a losing game for 99% of people. We're not day traders. We are long-term investors. So who are the winners? If you're a beginner in America, the undisputed champions of the world are Fidelity, Charles Schwab, and Vanguard. These are the titans. They've been around for decades, they manage trillions of dollars, and they have a rock-solid reputation. They are boring, and in the world of managing your life savings, boring is beautiful. Boring is safe. Let's focus on my personal favorite for beginners, and the one I recommend to my own family and friends, Fidelity. They are, in my opinion, the total package. First, let's talk about a feature that is an absolute game changer for new investors. Fractional shares. Let's say you want to invest in a great company like Costco, but a single share costs over $800. For most people starting out, that's a huge chunk of cash. Feels impossible. With fractional shares, Fidelity lets you buy a slice of a share. You don't have to buy the whole $800 pizza. You can buy a $1 slice. This means you can start investing in the world's greatest companies with as little as a single dollar. It completely demolishes the excuse of, "I don't have enough money to start." You can build a diversified portfolio of dozens of incredible companies with just $50 or $100. Second, Fidelity has zero-fee index funds. We'll talk more about index funds later, but just know they are one of the most powerful, simple, and effective ways to build wealth. And Fidelity offers a suite of them with a 0% expense ratio. That means it costs you literally nothing to own a basket of the entire US stock market. It's an incredible offer and a testament to their focus on the long-term low-cost investor. Third, their platform is phenomenal. The mobile app is clean and easy to use for beginners, but it also has incredibly powerful research tools hiding right under the surface for when you're ready to learn more. You can see analyst ratings, read detailed reports, and compare stocks side by side, all for free, right inside the app. And maybe most importantly, their customer service is fantastic. If you're confused, you can call them and talk to a real, licensed human being in the United States who will patiently walk you through your question. You can't put a price on that kind of support when you're starting out. Charles Schwab is a very close second. They offer almost all the same features as Fidelity. Fractional shares, great research, excellent customer service. You honestly cannot go wrong with either one. The interface is slightly different, so it really comes down to personal preference. It's like choosing between a Honda Accord and a Toyota Camry. They're both incredibly reliable, safe, and will get you where you need to go. And then there's Vanguard. Vanguard is the OG, the original pioneer of low-cost index fund investing, founded by the legendary John Bogle. They are fantastic, but I typically recommend them for people who are a little further along in their journey. Their platform historically has been a bit clunkier and less intuitive for the absolute beginner. It's built for die-hard, long-term, set-it-and-forget-it investors, which is a great philosophy, but might feel a little intimidating on day one. Now, what about the newer kids on the block like Robinhood or Webull? Look, these platforms did a great thing by bringing a whole new generation into investing with their slick, game-like interfaces. But that's also their biggest weakness. Their design can encourage overtrading and speculative behavior. For a beginner, building good, long-term habits is everything. Starting your journey on a platform that is stable, educational, and a little bit boring like Fidelity or Schwab is like learning to drive in a safe, reliable Volvo instead of a souped-up sports car. You'll become a much better driver in the long run. So, here is your first piece of actionable homework. Not tomorrow, not next week. Today. Pick one, Fidelity or Schwab. Go to their website and open an account. Takes about 10 minutes. You'll need your social security number and some basic information. You don't even have to put any money in it yet. The single most important step is just getting the door open. By doing that, you have officially moved from a passive observer to an active participant. You have built your home base. You have taken the biggest step. And now you're staring at a screen, maybe with a $0 balance, and a single paralyzing question is echoing in your mind. Now what? It's the same feeling as being handed the keys to a high-performance race car. You're sitting in the driver's seat, you can feel the potential humming beneath you. But you have no map, no understanding of the dashboard, and no idea how to even turn the engine on without launching yourself into a wall. This moment right here is where most people get overwhelmed and quit. They open the account, they take that first step, but then they're confronted by a tidal wave of information, and they freeze. Everywhere you look, there's noise. Financial news channels are screaming about the day's winners and losers. Social media is buzzing with hot stock tips and cryptic rocket ship emojis. Websites are throwing complex charts and blinking numbers at you that look like the control panel for a nuclear submarine. It feels like you're supposed to already be an expert just to understand the conversation. This is the great illusion of Wall Street. They want you to think it's a secret club with a language you'll never understand because when you're confused, you're more likely to pay someone else a lot of money to manage things for you. But I'm going to let you in on the real secret. You don't need to understand everything. You just need a few simple, powerful, and most importantly, free tools to cut through the noise and find the signal. You need to build your dashboard. You need your map. And we're going to build it right now. The first tool you need is your market weather station. Before you decide to invest in anything, you need to know the overall climate. Is it a sunny day, or is a hurricane rolling in? For this, you don't need a paid subscription to some fancy terminal. You just need a website like Yahoo Finance or Google Finance. Pick one, bookmark it, and make it your daily 5-minute check-in. When you open that page, ignore 99% of what you see. Your eyes should only go to three things. First, the S&P 500. Second, the NASDAQ. And third, the Dow Jones. These are what's known as market indexes. Think of them like this. The S&P 500 is a snapshot of the 500 largest, most influential companies in America. It's the best single indicator of how the overall U.S. economy and stock market are doing. The NASDAQ is similar, but it's heavily weighted towards technology companies. Think Apple, Microsoft, Amazon. The Dow Jones is the old-school one. It tracks just 30 massive blue-chip companies. All you need to know is, are these numbers green or are they red? If they're green, it means that, on average, the biggest companies in the country are having a good day. If they're red, they're having a bad day. That's it. That's your weather report. You don't need to know why, you don't need to analyze the percentage points. Just a quick glance. Green day or red day. This simple habit alone will start to build your intuitive feel for the market's rhythm. It's the first piece of your dashboard, the big, simple dial that tells you the overall mood. Okay, you've checked the weather. Now for the second tool. This is your company X-ray machine. Let's say you hear about a company. Maybe it's a brand you love, like Nike, or a company you hear about on the news, like Nvidia. Your first impulse might be to just buy the stock. Don't. Your first impulse should be to put it under the X-ray. You need to look inside and see what it's actually made of. Again, you don't need to pay for anything. A fantastic free tool for this is a website called Finviz. That's Finviz. It looks intimidating at first, like something out of the Matrix, but I want you to focus on its search bar. Type in the company's stock symbol, for example, Nike for Nike. What you'll get is a one-page, organized summary of everything you need to know. It's like the nutrition label on the back of a cereal box. And just like a nutrition label, you only need to look at a few key things to start. The first is market cap, which stands for market capitalization. This is the simplest and most important number. It's the total value of all the company's stock put together. It's the price tag for the entire company. Is it in the billions? Or the hundreds of billions? This tells you if you're looking at a giant stable battleship of a company or a tiny nimble speedboat. As a beginner, you want to stick to the battleships. Companies with market caps in the tens or hundreds of billions of dollars. They're less likely to sink overnight. The second thing to glance at is the PE ratio, which stands for price to earnings ratio. Don't let the name scare you. It's just a way of asking, is this stock cheap or expensive compared to how much money the company actually makes? A low PE, say under 20, might suggest the stock is a good value. A very high PE, like over 50, might suggest it's expensive and investors are expecting huge growth. You don't need to be an expert on this. Just look at the number. It gives you a quick vibe for whether you're shopping at a discount store or a luxury boutique. Using a tool like Finviz or even the research tab inside your new brokerage account gets you into the habit of looking before you leap. You're no longer just hearing a name and blindly throwing money at it. You're doing a 30-second checkup. You're being an investigator, not a gambler. Now we have our weather station for the whole market and our X-ray machine for individual companies. But this leads to a new problem. How do you even find companies to look at in the first place? There are thousands of them. This is where you need your third tool, an idea generator. Now this is dangerous territory. Most beginners get their ideas from the worst possible places. Speculation on social media or a hot tip from their cousin. This is the financial equivalent of taking medical advice from a random guy on the bus. We need a better, safer way to generate ideas. And here's one of the best-kept secrets for beginners. Use the pros as your shopping list. I'm talking about ETFs or exchange-traded funds. We're going to dedicate a whole future part to these, but for now, think of an ETF as a basket of stocks curated by professionals. For instance, the most famous ETF is called SPY. It's designed to perfectly mirror the S&P 500. So, if you want to know what the 500 biggest companies in America are, you don't have to guess. You can just look up the holdings of SPY. You can go to a site like ETF.com, search for SPY and click on Holdings. It will literally list out, from biggest to smallest, every single company in the fund. There's your idea list. Apple, Microsoft, Amazon, Google, Berkshire Hathaway. It's a pre-vetted list of the most successful, stable companies on the planet. You can do the same for other ETFs. Want to see the biggest tech companies? Look up the holdings for the ETF with the symbol QQQ. Want to see the biggest dividend-paying companies? Look up SHD. This isn't about just copying them. It's about using these professionally built lists as your starting point for research. Pick a name from that list that you recognize, a company whose products you use and understand. Then take that name and run it through your company X-ray machine. Finviz. Check its market cap, glance at its PE ratio. Read the one-sentence description of what the business does. Suddenly, you have a system. Process. You're not just floating in an ocean of information anymore. You have a workflow. Step 1. Check the market weather on Yahoo Finance. Step 2. Go to your idea generator like the holdings of a major ETF to find a company. Step 3. Put that company through the X-ray on Finviz to understand the basics. You can do all of this without investing a single dollar. You can paper trade, which is just a fancy way of saying you write down your ideas and track how they would have done. I would have bought 10 shares of Apple on this date at this price. Then watch it. See what happens. This is your flight simulator. You get to learn how the controls work and how the plane feels in turbulence without any actual risk. Practice this for a few weeks. Get comfortable with your new dashboard. What you're doing is building the most important asset an investor can have. A rational, repeatable process. You're removing the emotion, the hype, and the fear. You are replacing it with a calm, simple 3-step routine. You have your weather station, your X-ray machine, and your idea generator. You now have the basic tools to navigate the world of investing with more clarity and confidence than 90% of people who are just blindly throwing their money at whatever's trending on Twitter. You now have a map and a compass. You can understand the terrain. But the final question remains. Where do you actually take your first step? With all these companies to choose from, what is the safest, smartest, and most powerful first investment for someone just starting out? It's probably not what you think. It isn't about picking a single stock. It's about harnessing the power of the entire market in one simple move, using a tool that has been called the single greatest wealth-building engine for the average person ever created. And in the next part, we are going to break down exactly what that is and how you can make it your very first move. That tool is the index fund. More specifically, for our purposes, the exchange-traded fund or ETF that tracks a major market index. Now I know what you're thinking. Index fund? ETF. It sounds like financial jargon designed to make your eyes glaze over. It sounds complicated and boring. But I promise you, behind that bland name is one of the most revolutionary, most powerful, and most brilliantly simple ideas in the history of finance. And understanding it is the key that unlocks everything for a new investor. To really get why it's so incredible, you have to understand the world that existed before it. Imagine the stock market is a giant, sprawling supermarket. For decades, if you, the average American, wanted to invest, you had two choices. Choice 1, you could walk into that supermarket and try to pick out the best individual items. You'd walk down the aisles looking at thousands of different products, Apple, Ford, Coca-Cola, Pfizer, and you'd have to guess which ones were going to be the most valuable a year from now, 10 years from now, 30 years from now. You'd have to read every label, analyze every ingredient, and try to predict future shopping trends. Does that sound easy? Of course not. It's nearly impossible. You might get lucky and pick the one brand that becomes a global sensation. Or, far more likely, you could pick the one that goes out of business and your money vanishes with it. This is stock picking. It's a high-stakes, high-stress game that most people, even the so-called professionals, lose. Choice 2. You could hire a professional shopper to fill a cart for you. This is the old-school mutual fund manager. You'd walk up to a guy in a fancy suit at the front of the store and say, "Here's my money. Please go buy good stuff for me." And he'd say, "Absolutely." For a hefty fee, of course. He'd then go do the same thing you were trying to do. Guess which products are best. And here's the dirty secret of Wall Street they fought for decades to keep hidden. Most of these professional shoppers are terrible at it. Study after study has shown that the vast majority of them fail to even match the performance of the overall supermarket. But win or lose, they always took their fee year after year, slowly eating away at your profits. So you were trapped. Either gamble it all on your own limited knowledge or pay someone a fortune to gamble it for you, often with worse results. For the average person, it was a rigged game. It was the Wall Street casino, and the house always won. Then, in 1975, a man named John Bogle came along and flipped the entire table over. He was an industry insider, the head of a company called Vanguard, and he had a radical, almost heretical idea. He looked at this giant supermarket, the entire US stock market, and said, "Why are we trying so hard to find the single best apple in the store? Why are we paying guys in expensive suits to guess which can of soup will be a bestseller?" The supermarket itself, the whole American economy, is an incredible engine of growth. So, what if we just buy the whole store? Instead of trying to find the needle in the haystack, he said, let's just buy the entire haystack. This was the birth of the first index fund. It was a single simple product that didn't try to pick winners. It didn't employ high-paid analysts or genius traders. It just bought a tiny piece of every major company in the US market. In the case of the most famous index, the S&P 500, it bought a tiny slice of the 500 largest, most influential companies in America. When you buy one share of an S&P 500 index fund ETF, you are not just buying a piece of Apple. You are, in one single click, buying a piece of Apple and Microsoft and Amazon and Google and Tesla and Johnson & Johnson and Walmart and a couple hundred more. You own a tiny sliver of the entire engine of American capitalism. The financial industry at the time laughed at him. They called his idea Bogle's folly. They called it un-American. Why? Because it threatened their entire business model. His fund didn't need fancy managers, so it didn't have to charge high fees. It exposed the fact that the pros weren't really earning their keep. It took the power away from Wall Street and gave it directly to the individual. And what happened? Bogle's folly went on to become the single most successful financial innovation of the 20th century, turning millions of ordinary people, teachers, plumbers, nurses, engineers, into millionaires. So let's break down the 3 superpowers of the index fund ETF that make it the perfect tool for a beginner. Superpower number 1 is instant diversification. This is just a fancy way of saying, don't put all your eggs in one basket. If you bet your life savings on one single company, and that company goes bankrupt, you lose everything. It's a terrifying risk. But if you own a tiny piece of 500 companies, if one of them fails, it's a tiny blip. It barely even registers. Another company will simply grow to take its place. The index fund is the ultimate safety net. You are no longer betting on a single horse. You are betting on the entire sport of horse racing. As long as the American economy continues to innovate and grow over the long term, which has been the single best bet in modern history, your investment will grow with it. Superpower number 2 is rock bottom cost. This is the one that Wall Street really hates. Remember those professional shoppers, the mutual fund managers who charged a high fee? That fee is called an expense ratio. In the old days, it was common to pay 1% or even 2% of your total investment every single year, whether you made money or not. That sounds small, right? 1%. It's financial poison. A 1% fee can devour nearly a third of your potential earnings over your lifetime, due to the evil magic of compound interest working against you. But because index funds are simple and run by computers, their expense ratios are absurdly low. We're talking 0.03%. That's not 1%. That's 0.03%. The difference is staggering. On a $10,000 investment, a 1% fee costs you $100 a year. A 0.03% fee costs you $3. Over 30 or 40 years, that difference amounts to hundreds of thousands of dollars that stay in your pocket, not your fund managers. And superpower number 3 is a beautiful, beautiful thing: simplicity. You don't have to watch the market every day. You don't have to read earnings reports or listen to screaming heads on TV tell you what to buy or sell. You are playing a different game. Your strategy isn't to outsmart the market. Your strategy is to be the market. You buy your shares of the index fund, you keep buying them consistently over time, and you let the long-term growth of the economy do all the heavy lifting for you. It turns investing from a stressful, anxiety-inducing casino game into a calm, boring, and incredibly effective wealth-building plan. Now I can hear a little voice in the back of your head. It's the voice of temptation, the voice that watches movies about Wall Street. It's saying, but isn't this settling for average? I don't want average returns. I want to find the next Amazon. I want to hit a home run. That's a fair question. And here's the mind-bending answer. In investing, average is spectacular. The average annual return of the S&P 500 over the last 50 years has been around 10%. Some years it's up 30%, some years it's down 20%, but it averages out to a number that can turn a modest, regular investment into a life-changing fortune over time. And what about hitting those home runs? Even the greatest investor of all time, Warren Buffett, the master stock picker himself, has been crystal clear on this. He has repeatedly said that for the vast majority of people, the best thing they can do is to consistently buy a low-cost S&P 500 index fund. In fact, he's directed that 90% of the money he leaves for his wife and his will should be put into exactly that. The master of the game is telling you not to play his game. He's telling you to take the simple, proven path. So now you know the what. The tool is the low-cost index fund ETF. And you know the why. It gives you instant diversification, it's incredibly cheap, And it's brilliantly simple, allowing you to capture the growth of the entire market. It is the perfect foundation for any beginner's portfolio. But this brings us to the most critical practical question. PAM sold. But which one? There are thousands of ETFs out there. Which ones are the undisputed champions for a beginner building their first portfolio? And how, step by step, do you actually open an account and click the button to buy your very first share, making you an official owner of the American economy? That is the final barrier between you and becoming an investor, and it's the exact barrier we're going to smash in the next part. And that choice, that tool you use to buy a piece of a company, is called a brokerage account. It's the gateway. Think of it like this. If you want to buy groceries, you need to go to a grocery store. If you want to buy stocks, you need a brokerage. Simple as that. But here's where millions of people get paralyzed. You go to Google, you type in best brokerage for beginners, and you're hit with a tsunami of articles, ads, and top 10 lists. Fidelity, Schwab, Vanguard, E-Trade, Robinhood, Webull, M1 Finance, SoFi, the list goes on and on. It feels like you're standing in an aisle with 100 different brands of milk, and they all look basically the same. You get overwhelmed, you get decision fatigue, and you close the tab, telling yourself you'll figure it out later. And for many, later never comes. Today we end that. We're going to cut through all that noise with a simple framework. Because the secret is, there is no single best brokerage. The only question that matters is, what is the best brokerage for you? Your personality, your goals, your comfort with technology. To figure that out, let's sort these platforms into 3 main categories. First, you have the giants. These are the titans of the industry, the household names you've probably heard of even before you thought about investing. I'm talking about Fidelity, Charles Schwab, and Vanguard. These companies have been around for decades. They manage trillions, that's trillions with it, of dollars. They are the bedrock of the American financial system. The biggest advantage of going with the giant is trust and comprehensiveness. They are the Home Depot of investing. You can find everything under one roof: stocks, bonds, ETFs, mutual funds, retirement accounts, checking accounts, financial advisors, you name it. Their research tools are often incredibly powerful, giving you professional-grade data for free. And because they are so massive, your money is about as safe and secure as it can possibly be. But there's a downside to being Home Depot. If all you need is a single light bulb, navigating a warehouse the size of an airplane hangar can be a lot. Their websites and apps, while powerful, can sometimes feel a bit dated or cluttered. They were built for an older generation of investors, and while they've been updated for the modern era, they can still feel less intuitive than the newer players. For a complete beginner who just wants to buy one share of Apple, the sheer number of buttons, menus, and options can feel overwhelming. So the giants are for the person who says, I want it all, I want the most established name, and I don't mind a slightly steeper learning curve to have access to every tool imaginable. Next, we have our second category, the modernizers. These are the app-first, mobile-centric brokerages that exploded in popularity over the last decade. The most famous, of course, is Robinhood. But in this category, you'll also find companies like Webull and Public. Their philosophy is the polar opposite of the giants. They didn't start with a massive, everything-for-everyone platform. They started with a smartphone screen and asked, what is the absolute simplest, most beautiful, and most intuitive way for someone to buy their first stock? Their user interfaces are clean, slick, and often, dare I say, fun to use. Opening an account and making your first trade can take just a few minutes, right from your phone. They stripped away all the complexity. For many people, this was the key that finally unlocked the door to investing. Another massive advantage of the modernizers is that they pioneered making fractional shares mainstream. This is a game changer for beginners. Back in the day, if you wanted to buy a share of Amazon, you might have needed over $3,000 for a single share. It was prohibitive, but with fractional shares you can buy a small slice of that same share. You can invest in Amazon with just $5. This lets you build a diversified portfolio of incredible companies, even with a very small amount of money. Now the downsides. These platforms have faced criticism for the gamification of investing, using things like confetti animations to make trading feel like a game, which can encourage risky behavior. They also tend to have fewer in-depth research tools than the giants. And you've probably heard of the controversy around payment for order flow, which is a complex topic, but the simple version is that they make money by routing your trades through certain market makers. While this is a common industry practice, it's a source of debate. So the modernizers are for the person who values simplicity and user experience above all else. The person who says, just give me a beautiful app that lets me easily buy fractional shares of the companies I love, without all the confusing charts and jargon. Finally, we have our third category, the hybrids. These are platforms that try to blend the best of both worlds. They offer the ease of use of the modernizers but with a focus on long-term, automated investing strategies, similar to the philosophy of the giants. The best example here is M1 Finance. M1 has a really unique approach. Instead of having you pick and buy individual stocks one by one, they have you build what they call pies. A pie is just a portfolio of stocks and ETFs that you choose. For example, you could create a tech giants pie with 25% Apple, 25% Microsoft, 25% Google, and 25% Amazon. Then, whenever you deposit money, say $100, M1 automatically invests it for you, buying the right amount of each slice to keep your pie perfectly balanced. This is incredibly powerful for beginners because it automates good investing habits. It shifts your focus from short-term trading to long-term portfolio building. It's like having a subscription to a healthy meal kit service for your investments. You set up the menu once, and the right ingredients are automatically delivered and proportioned for you every time. The interface is clean and modern, but the underlying principle is all about disciplined, long-term wealth creation. So the hybrids like M1 are for the person who says, I want a modern app, but I don't want to be tempted to day trade. I want to set up a smart, diversified portfolio, and then put it on autopilot. Okay, the giants, the modernizers, and the hybrids. So which one do you pick? Let's make it dead simple. Forget the brand names for a second and just answer this one question. What kind of person are you? If you want the most trusted, most established name with every feature under the sun, and you're willing to spend a little time learning a more complex system, your answer is one of the giants. Go with Fidelity. It's a fantastic all-around choice. If your number one priority is a super simple, beautiful, mobile-first experience to just get started buying stocks and ETFs with a few clicks, your answer is one of the modernizers. Go with Robinhood or Public. They make the process incredibly easy. And if you love the idea of building a portfolio and then completely automating your investments in a modern interface, your answer is a hybrid. Go check out M1 Finance. That's it. That's the decision. Don't spend another week agonizing over it. They are all great tools that do the same core job. Let you buy investments. And no matter which one you choose, there are a few non-negotiable features you must ensure they have. Think of this as your beginner's brokerage checklist. Number 1. Zero commission fees for stock and ETF trades. This is standard now. Do not pay a fee to buy or sell a US stock. Period. Number 2. No account minimums. You shouldn't need $5,000 to get started. All the best platforms let you open an account with $0 and start investing with as little as $1. Number 3. Fractional shares. As a beginner, this is your superpower. It allows you to invest in the world's greatest companies, no matter how expensive their shares are. This is a must-have. And number 4. SIPC insurance. This is crucial. It stands for the Securities Investor Protection Corporation. It's an insurance policy that protects your investments up to $500,000 in the very, very unlikely event that your brokerage firm goes bankrupt. Every single legitimate brokerage in the United States has this. They don't run. Every platform I've mentioned, Fidelity, Robinhood, M1 Finance, and the others, they all check every single one of these boxes. You can't make a truly bad choice here. The most important thing is to just make a choice. Pick the one that resonates most with you right now. You can always change later. I have accounts at multiple brokerages for different purposes. Your mission, your only goal after watching this, is to go to the website or the app store for the one you chose and simply open the account. That's it. Don't even fund it yet. Just go through the process of signing up. Takes about 10 minutes. You'll need your social security number and some basic personal information. This is the step that takes you from a passive observer to an active participant. You've chosen your tool. You've opened the box. But now, what kind of money should you put in it? And in what type of account? Should it be a standard brokerage account? Or a special tax-advantaged retirement account like a Roth IRA? That single decision can be the difference between paying a 30% tax on your gains or paying zero. Absolutely nothing. That choice can literally save you tens or even hundreds of thousands of dollars over your lifetime. And it's exactly what we're breaking down next. Okay, so let's talk about taxes. Imagine you invest $1,000 and over the years it grows into $10,000. You've made a $9,000 profit. Awesome, right? Well, when you go to sell that investment and use the money, Uncle Sam is standing right there with his hand out. If you held that investment for less than a year, it's considered a short-term capital gain. and you'll pay tax on that $9,000 at your regular income tax rate. For many people, that's 20, 25, even over 30%. So, almost $3,000 of your profit is gone. Poof, vanished. If you held it for more than a year, it's a long-term capital gain, which is better. The tax rates are lower, usually 15 or 20% for most people. But still, that's over $1,000 handed over to the government just for being a successful investor. Now, multiply that over a 40-year career with hundreds of thousands, or even millions of dollars in gains. We are talking about a staggering amount of money. A life-changing amount of money that you earned but that you never get to keep. This is the reality for millions of investors who use a standard, taxable brokerage account. But what if I told you there was a secret door? A government-approved 100% legal way to sidestep this entire process. A way to invest that same $1,000, watch it grow to $10,000, and when you take it out you pay zero. Not 15%. Not 30%. Zero. That entire $9,000 profit is yours to keep. This isn't a loophole or a trick for the super rich. It's a tool, a special type of account, that the US government has created specifically to help regular Americans build wealth. And using these accounts is the single most important decision you will make as a new investor. These accounts are the financial equivalent of a cheat code. They are so powerful that the government actually limits how much money you can put into them each year. There are three main types we need to talk about, and understanding the difference is crucial. They are the Roth IRA, the traditional IRA, and the 401k. Let's start with the undisputed champion for most beginners, the Roth IRA. The letters IRA stand for Individual Retirement Arrangement. The key word here is Roth. Think of it like this: with a Roth, you pay your taxes up front. The money you put into a Roth IRA is money from your paycheck that you've already paid income tax on. It's post-tax money. It's like paying a tiny bit of tax on a small seed. Instead of paying a massive tax on the giant redwood tree it grows into 30 years later. So you open a Roth IRA, you contribute your post-tax dollars, up to a certain limit each year. It's usually around $6,000 or $7,000. You then invest that money in stocks, index funds, whatever you choose. And then the magic happens. Every single dollar of growth, every dividend, every bit of appreciation for years, for decades, it all grows 100% tax-free. And when you reach retirement age, typically 59 and a half, you can withdraw all of it, your original contributions and all of the massive growth, without paying a single penny in taxes. That $9,000 profit we talked about? It's all yours. That $100,000 profit? All yours. It is, without a doubt, the most powerful wealth-building tool the average American has access to. Now, there are income limits to contribute to a Roth IRA. Meaning if you make too much money in a year, you can't put money in directly. But for most beginners, this isn't an issue. If you are starting your investment journey, your number one priority should be to open a Roth IRA and try to max it out every single year. Next, we have its cousin, the traditional IRA. It's the mirror image of the Roth. With a traditional IRA, you contribute pre-tax money. This is the big advantage. The money you put in can often be deducted from your income for that year, which means you pay less in taxes today. So if you make $60,000 and you put $6,000 into a traditional IRA, you might only pay income tax on $54,000. Feels great to get that immediate tax break. Your money then grows tax-deferred inside the account. That means you don't pay any taxes on the growth year after year. The catch? When you pull the money out in retirement, every dollar you withdraw is taxed as regular income. So you're not avoiding taxes, you're just kicking the can down the road. You're choosing to pay tax on the giant redwood tree, not the seed. So why would anyone do this? Well, it makes sense if you believe you're in a much higher tax bracket now than you will be in retirement. If you're a high-earning doctor in your peak earning years, for example, getting a big tax deduction now might be more valuable than tax-free withdrawals later when your income is lower. But for most young investors, whose income will likely grow over their careers, the Roth IRA is almost always the better choice. Pay the taxes now while your tax rate is low. Finally, let's talk about the big one, the 401k. You've probably heard of this. This is the retirement plan offered by your employer. It works very similarly to a traditional IRA, where your contributions are usually pre-tax, lowering your taxable income today, and your money grows tax-deferred until you withdraw it in retirement. Many companies are now also offering a Roth 401k option, which is fantastic as it works just like a Roth IRA. But the 401k has a secret weapon, a feature so powerful that it makes it the best investment on planet Earth. And that is the employer match. Many companies will offer to match your contributions up to a certain percentage of your salary. A common offer is something like, We will match 100% of your contributions up to 3% of your salary. Let me translate that for you. That means we will give you free money. If you make $50,000 a year, 3% of that is $1,500. If you contribute $1,500 to your 401k, your company will deposit an additional $1,500 of their own money into your account. For free. You have instantly doubled your money. You have made a 100% return on your investment before it has even had a chance to grow. You will never ever find a better deal in the entire world of finance. Not in stocks, not in crypto, not in real estate. Nothing beats a guaranteed 100% return. So, if your employer offers a match, you must, and I mean must, contribute enough to get the full match. Not doing so is literally turning down a portion of your salary. It's like your boss is handing you a stack of cash and you're just saying, "No thanks, you can keep it." Don't do that. So how do you put this all together? You have these different accounts, these incredibly powerful tools. What's the right order? It's actually very simple. Here is the beginner investor's order of operations. Step 1. If your employer offers a 401k with a match, contribute just enough to get the full match. Not a penny more, not a penny less for now. Secure the free money first. Step 2. After you've secured the match, take any additional investment money you have and max out a Roth IRA. Funnel every dollar you can into this account until you hit the annual contribution limit. The promise of tax-free growth is just too powerful to ignore. Step 3. If you are fortunate enough to have maxed out your Roth IRA for the year, and you still have more money you want to invest, now you go back to your 401k and contribute more to it, up to its own much higher annual limit. And only after you have done all of that, after you've squeezed every last drop of tax-advantaged juice out of your retirement accounts, only then should you consider opening a standard, taxable brokerage account. These accounts, the 401k, the Roth IRA, the traditional IRA, are not just places to hold your money. They are the foundational tools that separate casual investors from serious wealth builders. They are the government-sanctioned shelters that protect your hard-earned money from the storm of taxes, allowing it to grow and compound into a truly life-changing nest egg. Choosing the right account is even more important than choosing the right stock. Okay, so you've done it. You've followed the steps. You've opened the ultimate tax-free account. You've funded it. You log in, and you're staring at a screen with thousands of ticker symbols, mutual funds, and ETFs. The feeling of empowerment is suddenly replaced by a feeling of paralysis. What do you actually buy? How do you build a portfolio that can weather any storm and grow for decades without you having to stress about it every single day? That's the million-dollar question, and the answer is surprisingly simple and far less complicated than you think. It's called diversification, but not in the way most people think about it. The old-school advice was to buy 10, maybe 15 different stocks from different industries. A bank, a tech company, a retailer, a healthcare giant. And for a long time, that was sound advice. But it was also a ton of work. You had to research each company, track its earnings, and pray one of them didn't have a massive scandal that wiped out your investment. It was like trying to build a championship-winning basketball team by scouting every single high school player in the country. It's possible, but the odds are stacked against you. And the effort is monumental. But what if you didn't have to pick the individual players? What if, with a single click, you could just bet on the entire league? What if you could own a tiny piece of every single major player all at once? That is the simple, elegant answer. You don't build a stormproof portfolio by picking a handful of stocks you hope will survive. You build it by owning the whole forest, not just a few trees. When you own the entire market, you are no longer betting on the success of Apple over Microsoft or Coca-Cola over Pepsi. You are betting on the long-term growth and innovation of the entire American economy. And historically, that has been the safest, most profitable bet in the world. So how do you do this? How do you buy the entire market? You do it with a revolutionary financial tool called an ETF, or an exchange-traded fund. And I know the name sounds boring and complicated, like something you'd hear in a stuffy boardroom. But I want you to forget the name and focus on the concept because it is brilliantly simple. Think of an ETF as a shopping basket. Imagine you walk into the stock market supermarket. Instead of going down the aisles and picking out individual stocks one by one, a share of Apple here, a share of Amazon there, you can just grab a prepackaged basket. One basket, labeled the 500 biggest American companies, already has a little piece of all 500 of them inside. Another basket might be labeled top tech innovators, and it's filled with all the major tech stocks. You buy the single basket and you instantly own everything inside it. That's an ETF. It's a fund that holds a collection of stocks, but it trades on the stock exchange just like a single stock like Apple or Tesla. You can buy and sell it all day long. It's the ultimate combination of diversification and simplicity. This invention, the ETF, is single-handedly the greatest tool ever created for the beginner investor. It allows you to achieve the kind of diversification that, just a generation ago, was only available to the wealthiest people and the largest institutions. Now, with as little as $100, you can own a slice of the entire US economy. Okay, so you're sold on the idea. Baskets are better than picking individual ingredients. But now you walk into the supermarket and you see there are thousands of different baskets. How do you pick the right one? How do you sort through the noise and find the high-quality, low-cost ETFs that will form the bedrock of your portfolio? For this, we need our next tool. It's not a brokerage, it's not a charting platform. It's a specialized search engine, a powerful encyclopedia for ETFs. And the one I recommend for beginners because of its clean interface and powerful free tools is VettaFi. That's VettaFi. You can think of it as the Google for ETFs. It's a database that lets you screen, compare, and analyze virtually every ETF on the market. Now, when you first land on a site like this, it can feel overwhelming. You'll see tickers and charts and numbers flying everywhere. I want you to ignore 99% of it. As a beginner building a long-term portfolio, you only need to focus on a few key metrics to find what I call bedrock funds. These are the funds that should make up the core of your portfolio. So let's walk through it. Imagine you're on the VettaFi ETF database page. You see a big list of funds and a bunch of filters. Here is the simple 3-step filtering process to find a high-quality US stock market ETF. First, you're going to look for a filter for asset class. You want to select equity. Equity is just the fancy Wall Street word for stocks. This immediately clears out all the other complex stuff like bonds, commodities, and currencies. We're keeping it simple. We want to own businesses. Second, you'll look for a filter related to geography or region. You'll want to select North America, or more specifically, US. This ensures we are only looking at baskets of American companies, which is the perfect starting point for a US investor. Now, you've narrowed it down from thousands of ETFs to a few hundred. This is where the magic happens. We're going to apply the most important filter of all. This is the secret that separates savvy investors from amateurs who lose a fortune over their lifetime without even realizing it. You need to find the filter called the expense ratio. The expense ratio is the single most important number you need to look at. It's the small annual fee the fund company charges to manage the basket for you. It's expressed as a percentage, and your goal is to get this number as close to zero as humanly possible. We're talking about numbers like 0.1% or lower. Many beginners completely ignore this. They see an ETF with a 1% expense ratio and think, 1%? That's tiny. What's the big deal? Let me tell you what the big deal is. A 1% fee doesn't sound like much, but over an investing lifetime of 30 or 40 years, it acts like a parasite, silently eating away at your returns. Let's say you invest $10,000 and it grows at 8% a year for 30 years. In a fund with a rock-bottom 0.03% expense ratio, you'd have about $99,000. Not bad. But in a fund with a 1% expense ratio, that same investment would only grow to about $75,000. That tiny fee just cost you $24,000. It's the biggest, most avoidable mistake in investing. So when you're on VettaFi, you sort the list by expense ratio from lowest to highest. The best funds for the core of your portfolio will have fees that are practically free, often under 0.1%. After you've sorted by the lowest fees, there are two other columns to glance at to confirm you found a winner. The first is Assets Under Management, or AUM. This is simply the total amount of money other people have invested in the fund. You want this number to be big. We're talking billions, not millions. A large AUM means the fund is popular, stable, and trusted. It's a sign of a healthy, well-run fund. The second is Average Daily Trading Volume. This just tells you how many shares of the ETF are bought and sold each day. Again, you want this number to be big, ideally in the millions. A high volume means the fund is liquid, which is a fancy way of saying it's incredibly easy to buy or sell at a fair price whenever you want. So let's recap the process. Go to the ETF screener, filter for US equities, then sort the entire list by the lowest expense ratio. From those top results, just glance over and make sure they have billions in AUM and high daily trading volume. That's it. You have just used a free, powerful tool to cut through thousands of options and identify the absolute best-in-class, blue-chip funds on the market. When you do this, you'll start to see the same names pop up. You'll see funds that track the S&P 500, the 500 largest companies in the US. You'll see funds that track the total US stock market, which includes thousands of companies large and small. For example, you might find a fund like the Vanguard S&P 500 ETF, ticker symbol VOO. You'd look at its page and see an expense ratio of something absurdly low like 0.03%. You'd see its AUM is hundreds of billions of dollars. You'd see its daily volume is in the millions. Ding ding ding. You found a bedrock fund. With one purchase of one share of this ETF, you are instantly a part owner of Apple, Microsoft, Amazon, Johnson & Johnson, and 496 other powerhouse American corporations. This is the answer to the million-dollar question. This is how you build a portfolio that can weather the storm. Because if one of those 500 companies goes bankrupt, it barely makes a dent. Your wealth is no longer fragile. It's robust. It's tied to the broad, powerful engine of the American economy. You've used a simple tool to execute a profound strategy, and it probably took you all of 5 minutes. You now possess the knowledge to find the building blocks of an incredible, low-cost, diversified portfolio. You know how to find the best ETFs in the world. But this leads to the next critical question. Finding the right Lego bricks is one thing. Knowing how to put them together to build an unshakable fortress is another. How many of these funds do you need? Should you just buy one that tracks the S&P 500? Or should you combine it with others? What about international companies? And how do you put them together in the right proportions to match your own goals and your own tolerance for risk? This is the single most important question in all of investing. Because having the best ingredients in the world doesn't matter if you don't have a recipe. You can have the best stocks, the best ETFs, the finest assets money can buy. But if you throw them together without a plan, you don't get a gourmet meal. You get a chaotic, inedible mess. What you're building is not just a collection of stocks. You're building a financial engine. And every part needs to work together in perfect harmony. This process is called asset allocation, and it is, without a doubt, more important than picking any single winning stock. In fact, studies have shown that over 90% of your investment returns are determined by your asset allocation, not by the individual stocks you pick. So how do we do it? How do we build that perfect portfolio recipe? Well, I'm going to show you 3 incredible tools. Each one represents a different path, a different philosophy for solving this exact problem. We'll call them the private chef, the recipe book, and the all-in-one meal kit. Let's start with the first, and for many people the best option, the private chef. Imagine hiring a world-class financial chef whose only job is to create the perfect investment portfolio tailored specifically for you. They'd ask you a bunch of questions. How old are you? When do you need this money? How do you feel when the market drops? Are you cool as a cucumber? Or do you start panic selling everything? Based on your answers, they would then build you a globally diversified, low-cost portfolio of ETFs, perfectly balanced to match your goals. And the best part? They would manage it for you day in and day out, automatically rebalancing it to keep it on track. This sounds like a service reserved for millionaires, right? Well, a decade ago it was. But today, it's available to everyone, and it's called a robo-advisor. Companies like Betterment and Wealthfront are the 2 titans in this space. They are, in essence, your digital private chef. You sign up, you take a simple, intuitive questionnaire, it usually takes about 10 minutes, and their Nobel Prize-winning investment theory algorithms do the rest. They will build you a portfolio that answers all those questions we just asked. It will typically include an S&P 500 fund, but it will also include ETFs for smaller US companies, international stocks from developed countries like Germany and Japan, stocks from emerging markets like Brazil and India, and a mix of US and international bonds to act as a stabilizer. They solve the entire asset allocation problem for a tiny fee, usually around 0.25% per year. For a $10,000 portfolio, that's about $25 a year. It's an incredibly powerful tool for a beginner because it forces you to start with a solid, diversified plan from day one, preventing you from making the classic mistake of just buying a handful of popular tech stocks and calling it a day. If you want the simplest, most hands-off, professionally managed approach, a robo-advisor is an absolute game changer. But what if you're the kind of person who likes to cook for themselves? What if you want to understand the recipe? You want to know why you're adding a pinch of international stocks and a dash of bonds. You want to be in control. For you, there is our second tool, the recipe book. And the best recipe book on the entire internet is a website called Portfolio Visualizer. And it's completely free. Portfolio Visualizer is like a financial time machine. It lets you test your investment ideas to see how they would have performed in the past. It's one of the most powerful tools available to a regular investor, and it lets you answer those complex questions yourself, using real historical data. Let's do a quick example. You're wondering, should I just put all my money into an S&P 500 ETF like VOO? It's a great question. So you go to Portfolio Visualizer, you go to their backtesting tool, and you create Portfolio 100% VOO. Then you think, okay, but what if I diversify a bit? So you create Portfolio 2, a classic 3-fund portfolio. Let's say 60% in a total US stock market fund, 30% in a total international stock market fund, and 10% in a total US bond fund. You plug these two portfolios into the tool, and you hit Analyze. Instantly, it will spit out a chart showing you exactly how both portfolios would have performed over the last 10 or 20 years. You'll see the final balance, the average annual return, and this is the most important part, the volatility. You might find that the S&P 500 portfolio had a slightly higher return, but you will almost certainly see that the diversified 3-fund portfolio was a much smoother ride. Its worst year would have been less bad. Its biggest drop from a peak to a trough would have been smaller. The tool will even give you something called a Sharpe ratio, which is a fancy way of measuring how much return you got for the amount of risk you took. A higher Sharpe ratio is better, and the diversified portfolio almost always wins on this metric. Using this tool for just 30 minutes will teach you more about portfolio construction than reading a dozen books. You can test anything. What happens if I add gold? What if I add real estate? What if I have more bonds? It's your personal investment sandbox, your recipe book for building a resilient, long-term portfolio. It turns you from a passive passenger into an informed architect of your own financial future. Now that brings us to our third and final tool, which sits in a beautiful sweet spot between the first two. The all-in-one meal kit. This is for the person who wants a simple, proven recipe but doesn't want to bother with the cooking or the ongoing management. This tool is called a target date fund, and it is one of the most brilliant and underrated inventions in modern finance. You've probably seen them inside your 401k at work. They have names like Vanguard Target Retirement 2060 Fund or Fidelity Freedom 2055 Fund. The concept is pure genius. You simply choose the fund with the year in its name that's closest to when you plan to retire. So if you're 30 years old today and plan to retire around age 65, you'd pick a 2060 fund. And that's it. You're done. You just buy that one single fund for your entire life. But what's happening inside that fund? It's a fully diversified portfolio, just like the one a robo-advisor would build for you. It holds US stocks, international stocks, and bonds, all in one neat package. But it has one extra piece of magic. It automatically and gradually changes its recipe over time. This is called its glide path. When you're young and decades away from retirement, a 2060 fund will be very aggressive, maybe 90% stocks and 10% bonds, because you have time to recover from market downturns. But as you get closer to that 2060 date, the fund automatically starts selling off stocks and buying more bonds. By the time you're ready to retire, it might be a much more conservative 50-50 mix. It solves the asset allocation problem for you today, and it continues to solve it for you for the next 40 years, without you ever having to lift a finger. It takes on more risk when you can afford it and reduces risk as your life savings become too precious to lose. It's a brilliant, set-it-and-forget-it solution that combines professional diversification with a long-term, automated strategy. So there you have it. 3 incredible tools to solve the million-dollar puzzle of portfolio construction. The private chef of robo-advisors like Betterment and Wealthfront for a completely hands-off, tailored experience. The recipe book of Portfolio Visualizer for the DIY investor who wants to test and learn and be in complete control. And the all-in-one meal kit of target date funds for a simple, elegant, and lifelong solution in a single ticker symbol. You now have the game plan. You know what ingredients to look for, and you have the recipe to put them all together. But there's one final crucial piece of the puzzle. You need a place to actually buy and hold these investments. You need a kitchen. And choosing the right kitchen, the right brokerage account, can be the difference between a smooth, low-cost journey and one filled with frustrating fees and hidden costs that slowly eat away at your returns. There are hundreds of options out there, but only a few are truly built for the long-term beginner investor. So let's cut through that noise. When you're starting out, you aren't looking for a platform designed for a high-frequency day trader who needs 15 screens and real-time level 2 data. You are looking for a trusted partner, a financial fortress, a place that is secure, low-cost, and easy to understand. You need a co-pilot, not a space shuttle cockpit. And in the United States, 3 names consistently rise to the top for this exact purpose. They are the Titans, the gold standard, Fidelity, Vanguard, and Charles Schwab. Choosing between these 3 is like choosing between a top-of-the-line Ford, a Toyota, and a Honda. There is no truly bad choice here. They are all reliable, they'll get you where you need to go, and they're trusted by millions. But they each have a slightly different feel, a different philosophy, and a different set of features that might make one the perfect fit for you. Let's start with Fidelity. Think of Fidelity as the ultimate all-rounder. It's the decathlete of brokerage firms. It does everything, and it does everything exceptionally well. For a beginner, Fidelity's user experience is probably the best in the business. Both their website and their mobile app are clean, intuitive, and powerful without being overwhelming. They've spent a fortune making sure that buying your first investment is as easy as ordering a book online. But where Fidelity truly shines for a new investor are 2 game-changing features. First, fractional shares. This sounds technical, but it's beautifully simple. Let's say you want to invest in a company like Chipotle, but 1 share costs over $3,000. For most of history, you were just out of luck until you saved up that much. Fidelity lets you buy a slice of a share. You can invest just $50 or even $5 into Chipotle and own a tiny fraction of it. This single feature demolishes the barrier that a stock is too expensive. It means you can build a diversified portfolio of the world's greatest companies with just a small amount of money. Second, Fidelity offers a suite of zero-expense ratio index funds. Let that sink in. These are funds that track major market indexes like the S&P 500, and they charge you absolutely nothing, 0.0%, in management fees. This was unheard of just a few years ago. It means that every single penny of your investment is working for you, not being siphoned off to pay for fund managers. Combine this with zero commission trades on stocks and ETFs, and you have a platform that is fundamentally designed to keep as much of your money in your pocket as possible. Add in their top-tier customer service that's available 24/7, and you have the reason why Fidelity is often my #1 recommendation for someone starting from scratch. It's simple, powerful, and incredibly cost-effective. Now let's talk about Vanguard. If Fidelity is the modern all-rounder, Vanguard is the wise, principled grandfather of low-cost investing. You cannot talk about Vanguard without talking about its legendary founder, Jack Bogle. He was the man who single-handedly invented the index fund for individual investors. His entire philosophy was that trying to beat the market is a loser's game for most people, and that the key to building wealth was to simply buy the entire market through a low-cost index fund and hold on for the long term. Vanguard as a company is built on this very principle. In fact, their corporate structure is unique. Vanguard isn't owned by private shareholders or a founding family. It's owned by its own funds, which in turn are owned by the people who invest in them, that's you. This means the company's profits are returned to the investors in the form of lower fees. Their interests are perfectly aligned with yours. It's a beautiful pro-consumer model. Their specialty, as you can guess, is their own suite of world-class, ultra-low-cost ETFs and mutual funds. Investing in funds like VTI, which tracks the entire US stock market, or VOO, which tracks the S&P 500, is the quintessential Vanguard experience. Now, for years, the trade-off was their technology. Their website and app felt a bit dated, a bit clunky. Some people even joked that this was a feature, not a bug. It discouraged you from logging in too often and tinkering with your investments, forcing you to be a good long-term investor. In recent years, they've made huge strides in updating their user interface, but it's still generally considered more Spartan than Fidelity's. Vanguard is for the purist. It's for the investor who has read Jack Bogle's books, believes deeply in the buy and hold philosophy, and wants to align with the company that started it all. Finally, we have Charles Schwab. If Fidelity is the all-rounder and Vanguard is the purist, think of Charles Schwab as the premium integrated experience. Schwab's superpower isn't just its investment platform. It's how that platform seamlessly connects to one of the best banking solutions on the planet. With Schwab, you don't just open a brokerage account. You can open a Schwab Bank high-yield investor checking account right alongside it, with no fees and no minimums. And this checking account is a travel hacker's dream. It comes with a debit card that has 0 foreign transaction fees, and, get this, it offers unlimited ATM fee rebates worldwide. That means you can land in Tokyo, walk up to any ATM, pull out yen, and Schwab will refund whatever fee that local ATM charged you. It's an incredible perk that can save you hundreds of dollars if you travel. This integration makes managing your money effortless. You can instantly transfer cash between your checking and investment accounts. The platform itself is robust, having absorbed the legendary Thinkorswim platform from their acquisition of TD Ameritrade, offering tools that can grow with you from beginner to expert. Like the others, they offer zero-commission trades and their own lineup of excellent low-cost ETFs. Schwab's customer service is also legendary, with 24/7 support and hundreds of physical branches across the country if you ever want to talk to a human face-to-face. So how do you choose? Comes down to what you value most. Choose Fidelity if you want the best overall, most user-friendly digital experience. If the idea of buying fractional shares of any stock or ETF is exciting to you, and you want access to those groundbreaking zero-fee index funds, Fidelity is likely your best bet. It's the path of least resistance to get started and has the depth to last you a lifetime. Choose Vanguard if you are a buy-and-hold purist. If your plan is to simply dollar-cost average into a few core Vanguard ETFs for the next 30 years, and you value alignment with the company's pro-investor mission above all else, Vanguard is your spiritual home. You're not there for the bells and whistles. You're there for the philosophy. Choose Charles Schwab if you want a single, elegant solution for your entire financial life. If the idea of having a world-class checking account seamlessly linked to your brokerage account is a massive selling point, especially if you travel internationally, then Schwab is the undisputed champion. It's the ultimate convenience play. Now, while these are the big three, I do want to mention one more modern player that takes a slightly different approach: M1 Finance. M1 isn't a traditional brokerage where you buy and sell stocks. Instead, it's built around a concept they call pies. You create an ideal portfolio, your pie, by selecting stocks and ETFs and assigning a target percentage to each one. For example, 50% in an S&P 500 ETF, 30% in an international ETF, 10% in Apple, and 10% in Microsoft. Then whenever you deposit money, M1 automatically invests it across your pie, buying just the right amount of each slice to keep you at your target allocation. It also allows for automatic rebalancing. It is the ultimate tool for the investor who wants to design a strategy once and then put it completely on autopilot. It takes all the manual work and emotion out of the equation. The trade-off is less control. You don't time your buys during the day, as M1 has 1 or 2 trading windows. But for pure, automated set-it-and-forget-it investing, it's a brilliantly designed platform worth looking at. Ultimately, picking between Fidelity, Vanguard, and Schwab is a fantastic problem to have. You cannot make a catastrophic mistake here. The real key is to just pick one. Don't let analysis paralysis stop you. Open the account. It takes 15 minutes. Getting your money into the game is infinitely more important than spending 6 months agonizing over which of these A+ platforms is technically an A++. Once you have your home base established, your financial fortress built, you can then turn your attention to the next critical question. What do I actually buy? You've opened the account. You've funded it. You are standing at the starting line of your wealth-building journey. And before you is a vast, overwhelming sea of over 6,000 publicly traded companies in the United States alone. How do you possibly choose? How do you separate the next Amazon from the next disaster? This is where most beginners make their first, and often most costly mistake. They treat investing like gambling. They hear a tip from a friend, see a hyped-up stock on social media, or just buy a company they recognize, like the one that makes their favorite soda. This is the equivalent of trying to navigate a cross-country road trip, using nothing but a child's drawing of a map. You might get lucky, but chances are you're going to end up lost and broke. World-class investors don't guess. They investigate. They have a process. They have a toolkit. Let's use an analogy. Choosing your brokerage, which we just covered, is like choosing which car dealership to go to. You picked a good one. It's reputable, the fees are low, the service is great. But that doesn't tell you which car to buy. To do that, you need to look under the hood. You need to read the reviews. You need to check the safety ratings and the mileage. You need to become an informed buyer. The tools we're about to cover are your financial mechanics kit. They are your consumer reports, your Carfax, your deep dive diagnostic machine for stocks. And the best part? The most powerful ones for getting started are completely free. Let's break them down into 3 categories: the News Hub, the Screener, and the Deep Dive. First, the News Hub. This is your command center for information. It's where you go to get a quick, high-level overview of a company or the market in general. The undisputed champion here, the one you absolutely must have bookmarked, is Yahoo Finance. Yes, I know Yahoo might sound like a relic from the dial-up era, but its finance section is an absolute powerhouse. It's the Swiss Army knife for investors. You can type in any stock ticker, say Apple for Apple, and instantly get a dashboard of vital information. You'll see the current stock price, charts of its performance over days, months, or even decades. You'll find a running feed of all the latest news articles about that company from major sources like Reuters and the Associated Press. But here's where it gets really useful for a beginner. Click on the Financials tab. Don't be intimidated. You'll see the company's income statement, balance sheet, and cash flow statement. Yahoo Finance presents these in a clean, easy-to-read format. You don't need to be an accountant to understand the basics. Is revenue, the total money coming in, going up each year? Is net income, the profit, also going up? Just by looking at the trend over the last 3 or 4 years, you can get a powerful snapshot of the company's health. Is it growing or is it shrinking? It's a fundamental question that Yahoo Finance helps you answer in seconds. A close competitor is Google Finance. It does many of the same things as Yahoo, but with that classic clean Google interface. Its strong suit is its seamless integration with the Google ecosystem and its excellent portfolio tracking tools. Honestly, you can't go wrong with either. Think of Yahoo Finance as the reliable Toyota Camry and Google Finance as the sleek Honda Accord. Pick the one whose dashboard you like better, and make it your daily driver for market news. Okay, so you've got your news hub. You're keeping up with the headlines. But that's passive. How do you actively find new investment ideas? This brings us to our second and perhaps most powerful category of tool, the screener. Imagine you could tell a super smart assistant, I want to find a technology company, based in the US, that's profitable, has grown its sales by more than 10% last year, and isn't ridiculously expensive. And in less than a second, that assistant hands you a list of every single stock that meets your exact criteria. That's what a stock screener does. It's a filter for the entire market. And the best free screener on the planet is Finviz. That's Finviz. This website looks a little old school. It's not flashy, but it is unbelievably powerful. When you go to their screener page, you'll see dozens of filters. You can screen by market capitalization, the size of the company. You can screen by sector, tech, healthcare, energy. You can screen by fundamental metrics like PE ratio, which is a common measure of how expensive a stock is. Let's run a quick example. Right now, there are over 8,000 stocks in the Finviz database. It's an impossible number to sort through, but let's apply a few filters. First, under country, let's select USA. We're down to about 5,000. Now let's say we only want companies with a market cap over $2 billion, so no tiny ultra-risky companies. We're down to 2,000. Now let's add a profitability filter. We'll set PE ratio to under 30, and sales growth quarter over quarter to positive. Just like that, with a few clicks, we've taken an ocean of 8,000 stocks and narrowed it down to a manageable list of a few hundred promising candidates. This is how you move from guessing to strategizing. You are no longer just throwing darts. You are defining what a good investment looks like to you, and then using a powerful tool to find companies that fit your definition. Finviz turns an overwhelming market into a searchable database of opportunities. Now you have a short list of interesting companies. It's time for the final category of tools, the deep dive. This is where you put on your detective hat and truly investigate a business before you invest your hard-earned money. Our first deep dive tool is Seeking Alpha. While Yahoo Finance gives you the news and Finviz gives you the numbers, Seeking Alpha gives you the arguments. The platform is built on crowdsourced analysis. Thousands of investors, from amateur enthusiasts to seasoned professionals, write articles arguing for why you should buy a stock, the bull case, or why you should sell or avoid it, the bear case. The magic of Seeking Alpha is that for any stock you're considering, you can read detailed reports from both sides. If you're excited about a company, the most important thing you can do is read an intelligent, well-researched article about why you might be wrong. This is the ultimate defense against confirmation bias, the dangerous human tendency to only seek out information that agrees with us. Reading the bear case forces you to confront the risks. What are the company's weaknesses? Who are its biggest competitors? What could go wrong? If you can read a compelling bear case and still confidently believe in the company's long-term prospects, your investment thesis is 1,000 times stronger. But there's one source of information that is even more important than the news, the numbers, or the analysis of others. And it's the one most beginners never even think to look at. It's going directly to the source, the company's own investor relations website. Every publicly traded company is legally required to have one. Just go to Google and type in the company's name followed by Investor Relations. This is the company's official communication channel with its owners, the shareholders. That's you. Here you will find the raw, unfiltered truth. You'll find press releases, transcripts of earnings calls where executives answer questions from analysts, and most importantly, you'll find their SEC filings. The two you need to know are the 10Q, which is the quarterly report, and the 10K, which is the big one, the annual report. The 10K is the company's super detailed, legally binding report card for the entire year. It describes the business in detail, breaks down the financials, and crucially, lists the primary risks to the business in a section called Risk Factors. The company is legally telling you everything that could possibly go wrong. Reading this section is one of the most eye-opening and valuable things you can do as an investor. So let's put it all together. Your process looks like this. You use Yahoo or Google Finance to stay on top of the news and do quick lookups. You use Finviz to screen for new ideas that match your specific investment criteria. When you find a promising company, you go to Seeking Alpha to read the bull and bear arguments from other smart investors. And finally, you go straight to the source, the company's investor relations page, to read their own words in their annual report. This process transforms you from a passive gambler into an active investigator. You're no longer just buying a ticker symbol. You're buying a piece of a business that you have researched and that you genuinely understand. You have the brokerage to execute your plan, and now you have the toolkit to formulate that plan intelligently. You have the dealership and you have the mechanics tools. But there's one final critical piece of the puzzle. You can have the best car in the world and the most detailed inspection report, but if the person behind the wheel doesn't understand the rules of the road, or their own emotional blind spots, a crash is almost inevitable. That's why the final tool, the 10th and arguably most important tool in your entire arsenal, isn't an app, a website, or a piece of software. It's a mirror. The final tool is mastering the person staring back at you. It's about conquering the single greatest threat to your long-term returns, your own human psychology. Think back to March of 2020. The world was shutting down. The market was in a free fall, plummeting over 30% in a matter of weeks. Every headline screamed disaster. Every news channel showed charts dripping in red. The overwhelming human instinct in that moment was pure, unadulterated fear. It was the instinct to sell, to get out, to stop the bleeding and preserve whatever you had left. Millions of people did just that. They sold their shares in great American companies at the absolute bottom, locking in catastrophic losses. They let fear take the wheel. And what happened next? The market staged one of the fastest, most ferocious recoveries in history. Those who held on or even braved buying more saw their portfolios soar to all-time highs within a year. The difference between financial ruin and life-changing wealth wasn't a fancy stock screener. It was the ability to feel the fear and not act on it. The flip side of that coin is greed. Remember the meme stock craze of 2021? Stories were everywhere of people turning a few $1,000s into $100,000 seemingly overnight. This triggered a different but equally dangerous emotion. FOMO, the fear of missing out. People who had never invested before were suddenly throwing their life savings into highly speculative stocks they didn't understand, buying at absurdly inflated prices. Why? Because their neighbor's cousin's friend made a fortune, and they wanted a piece of the action. Greed made them abandon all logic, ignore fundamentals, and chase a rocket ship that had already left the launch pad. For many, it ended just as badly as the panic sellers of 2020. They bought at the peak, driven by greed, and rode it all the way down. Fear and greed are the twin demons of investing, and they are powered by a set of predictable psychological glitches in our brains that behavioral economists have studied for decades. One is called confirmation bias. This is our tendency to only look for and believe information that confirms what we already think. You fall in love with a company, you think it's the next big thing. So you start Googling. But you don't Google risks of investing in company X. No, you Google why company X is going to the moon. You read glowing articles, watch interviews with the brilliant CEO, and join online forums filled with other believers. You construct a perfect echo chamber that reinforces your decision, while actively ignoring the warning signs and bearish reports that could save you from a terrible investment. Then there's recency bias. This is where we give too much weight to recent events and assume they'll continue forever. If the market has gone up for 3 straight years, our brain starts to think that's the new normal. We become complacent and take on more risk than we should. Conversely, after a crash like 2008, people were so scarred they stayed out of the market for years, assuming another crash was just around the corner, and missed out on the longest bull market in history. They let the recent past dictate their entire future. And perhaps the most powerful bias of all is loss aversion. Psychologically, the pain of losing $100 is more than twice as powerful as the pleasure of gaining $100. This is wired into our DNA. It's what makes us sell a stock that's down 5% just to stop the pain, even if our long-term thesis is still intact. It's also why we'll hold on to a losing stock for way too long, praying it will get back to what we paid for it, because selling would mean we have to formally admit the loss, and that hurts too much. So how do you combat these deep-seated, powerful, and often subconscious biases? You can't just wish them away. You need practical, systematic tools to short-circuit your own emotional responses. The first and most critical is an investor policy statement, or what I just call a written investing plan. This is your personal financial constitution. It's a document you create when you are calm, rational, and clear-headed. In it, you write down, in plain English, your rules of engagement with the market. It should answer questions like, what are my financial goals and my time horizon? Am I saving for a house in 5 years or retirement in 40? This simple question dramatically changes your strategy. What is my risk tolerance? On a scale of 1 to 10, how much of a portfolio drop can I stomach before I lose sleep? Be brutally honest with yourself. What is my core strategy? For example, I will invest 80% of my money into a low-cost S&P 500 ETF, and 20% into individual stocks I have thoroughly researched using the tools from this series. What are my rules for buying and selling? For instance, I will only buy a stock if it meets these 5 specific criteria. I will only sell a stock if the fundamental reasons I bought it have changed, or if it grows to be more than 10% of my portfolio. I will never sell simply because the price has dropped. This document becomes your anchor in a storm. When the market is crashing and your gut is screaming sell, you don't have to think. You don't have to make a decision in a state of panic. You pull out your plan. You read the rules you set for yourself when you were thinking logically, and you follow them. It's a pre-commitment to rational behavior. The second tool for mastering your psychology is automation. This is your autopilot. The single best way to defeat fear, greed, and timing the market is to take yourself out of the equation. Set up an automatic transfer from your bank account to your brokerage account every single week, or every 2 weeks on the day you get paid. Then, set up an automatic investment from that cash into your chosen ETF or mutual fund. Could be $50, $100, $1,000, the amount doesn't matter as much as the consistency. This is dollar cost averaging in its purest form. When the market is high, your fixed amount buys fewer shares. When the market is low and everyone else is scared, your system automatically buys more shares at a discount. You're mechanically, unemotionally, executing a brilliant strategy without ever having to click the buy button and second-guess yourself. You are building wealth on autopilot, immune to the daily noise. The final and most difficult psychological tool is mastering the art of doing nothing. In a world that rewards constant action, trading, and tinkering, the most powerful move a long-term investor can often make is to simply sit on their hands. The data is overwhelmingly clear. The vast majority of your returns will not come from brilliant trades, but from time in the market. JP Morgan did a famous study that showed if you missed just the 10 best days in the stock market over a 20-year period, your total returns were cut in half. And guess when those best days usually happen? They often occur in the middle of terrifying volatility, right after the worst days. They happen when the people who panic sold are sitting on the sidelines, waiting for things to calm down. By the time it feels safe to get back in, the biggest gains have already happened. So, once you've used the tools to pick great investments and you've automated your contributions, your job is often to just let the system work. Let compounding do its magic over years and decades. Doing nothing isn't laziness. It's a disciplined, strategic choice. So let's bring it all home. We've talked about tools to find ideas like stock screeners. We've talked about tools to analyze companies like financial data platforms. We've covered tools to understand the big picture, like economic calendars and news terminals. We've even covered the tools that help you see what the pros are doing. But all of those are external. They are the map, the compass, and the vehicle. They are useless if the person in command is prone to panic, driven by impulse, and navigating by gut feeling instead of a well-laid plan. Building wealth in the stock market isn't a get-rich-quick scheme. It's a get-rich-sure process. It's a marathon, not a sprint. And the winner of that marathon isn't the person with the fastest computer or the most expensive subscription. It's the person who has mastered their own behavior. It's the person who pairs great external tools with an unbreakable internal framework. A written plan to keep them rational, automation to keep them consistent, and the discipline to do nothing when everything in their body is screaming to do something. You have access to more information and better tools than any generation of investors in history. Use them wisely. But never forget that the ultimate variable, the one factor that will determine your success more than any other, is you. Master that, and you're not just investing in the market, you're investing in a future you control.